Welcome, everybody. This is Politics by Jake. This is the weekend show. This is the Sunday show, actually. March 1st. I say it all the time. Holy cow, another month gone. Well, welcome to Politics by Jake. All of you new listeners, welcome all of you old viewers. Welcome to the show. Welcome to the fight. It's 2026. So let's get to it, shall we? Tonight, or I should say today, well, it could be tonight, depending on when you're watching it. We're not going to do slogans. We're not going to do outrage. We're going to talk about something far more important and far more dangerous, actually, to misunderstand. We're going to talk about the United States dollar as the world's reserve currency and what that actually means and what it requires and why it is nearly impossible, notwithstanding the attempts and the desires of many nations and many actors to replace it, why it is nearly impossible to replace, and why the conversation about crypto, de-dollarization, political volatility intersects directly with that status. Because here is the first thing you must understand. A reserve currency is not a popularity contest. It is plumbing. It is liquidity. It is scale under stress. And scale? Well, scale is everything. Now, let's start kind of at the beginning. Let's start with the foundation in Bretton Woods. In 1944, representatives of 44 nations met in Bretton Woods, New Hampshire. And at this time, this was during World War II, Europe was in ruins, Asia was devastated, and the United States emerged industrially intact. The U.S. held most of the world's gold reserves, so the system was built around the dollar. And the dollar was pegged to gold at $35 an ounce. And other currencies were pegged to the dollar. And this created a hierarchy. Gold at the top, dollar beneath it, world currencies beneath the dollar. And the system worked because it was anchored. This is the whole idea that you probably have not heard of. But it worked. It worked really well because it was anchored. It created trust. Trust created usage. Usage created dominance. Do you see? Dominance created reserve status. But by the late 1960s, strains appeared. There had been war spending. There had been domestic expansion, foreign governments accumulating dollars. Some of those governments began redeeming dollars for gold. France was one of those. De Gaulle was one of those. And in 1971, President Nixon suspended convertibility. By convertibility, it just simply means being able to get gold for your dollars. So in other words, in 1971, the gold window closed and the dollar became fully fiat. And fiat is a Latin term. It's the subjunctive. If you remember your old Latin, those of you who took Latin, you went to the subjunctive, and that was like let it. So fiat literally means let it be. So let it be written, so let it be done. Let it be. That's fiat money. And that moment is critical. From that point forward, the dollar was backed not by gold, but by institutional credibility. And that credibility was built on three pillars. Number one, the rule of law. Number two, market depth. And political stability. After 1971, the United States negotiated arrangements with Saudi Arabia and other oil producers so that oil would be priced in dollars. Energy importers would need dollars. Those dollars would often be recycled into U.S. treasuries. This created a structural global demand. The dollar became not just currency, but energy infrastructure. And here is where people begin to misunderstand. This is where you get a lot of people talking on YouTube and on Instagram, and they're telling you that things are different than what you think it is. And reserve status It's not moral. It's not morality. It's structural. You often hear the claim that the dollar has lost 95% of its value. That refers to purchasing power since 1913. It's not like 90% of its 95% of its value since last year or since 2020. It goes back to 1913. So let's inject a little elaboration on that, shall we? A little context, a little clarity, perhaps, a little orientation, okay? When people say the dollar has lost 95% of its value, they're talking about long term inflation since the Federal Reserve was created in 1913. So, what does that mean in plain English? Well, it means that $1 in 1913 bought roughly what $20 to $25 buys today. That's cumulative inflation, you see, over more than a century. And that sounds dramatic, 95%. That sounds dramatic. But here's the nuance. Every industrial economy experiences inflation over long time horizons. The relative question is not whether purchasing power declines over a century. No. The relevant question is this: whether the currency remains trusted, liquid, and dominant in global settlement. And those are two different conversations, and you shouldn't confuse them. Yes, long-term inflation erodes purchasing power. That is true of every fiat system. But inflation over a century in a growing industrial economy, that's not collapse, okay? The relevant question is not purchasing power alone. It is settlement dominance and liquidity capacity. That is the reserve question. Now, let's talk about what it actually, and I think this part is kind of going to blow your mind, because when I first heard it, it kind of made me step back in awe, as it were. Let's talk about what it actually takes, okay, to be a reserve currency. So, to be a reserve currency, you must meet non-negotiable conditions. Number one, a deep sovereign bond market measured in tens of trillions. Number two, open capital accounts. That means they're open. That doesn't mean you can open them. But open capital accounts and no capital controls. Number three, legal transparency, trusted by foreign governments. Number four, political continuity, and the ability to supply massive liquidity upon demand. And when I say massive, I'm about to tell you, let's quantify massive, okay? Let's really go down the rabbit hole and see how far that goes. Global foreign exchange markets trade not 6 to 7 million, not 6 to 7 billion, 6 to 7 trillion dollars per day. And normal global liquidity require, absolutely must have $1 to $2 trillion daily in settlement. And in crisis, that number goes up. It goes up to like 5 or 6 trillion. Overnight, without hesitation. If you cannot supply that, you cannot be the reserve currency. Period. And the United States, the dollar, it's the only one that can do that. Russia, capital controls, disqualified, can't do it. Small economy, smallish economy. The ruble, don't make me laugh. It's not going to happen. Saudi Arabia, oil wealth, that's not bond market depth. So they're disqualified. The euro, closer, but it lacks unified fiscal sovereignty. China and the renminbi, the yuan is not fully convertible anyway. Capital restrictions, legal opacity. No. To replace the dollar, you must absorb global savings. You must provide unlimited liquidity. Unlimited liquidity. You must allow unrestricted convertibility and maintain the rule of law trusted by adversaries. And no one else currently can. And that is the profound reality. And at this point, let's take a break, and we'll be right back. And this is Politics by Jake. And now here's a word from one of our sponsors, Twain Consulting. Hi, this is Jake with Twain Consulting. Let's be blunt, shall we? America is litigious. It's unstable, and it's financially weaponized. If your name is on everything you own, you're a sitting duck. At Twain Consulting, we help you vanish legally, ethically, and permanently. From land trusts to layered LLCs, we teach you how to restructure your assets so the predators can't see them and can't touch them. This isn't a loophole. It's a strategy that the wealthy have used for decades. Isn't it time you got the same protection? Call Twain Consulting at 805-380-5699 or visit us online. Protect what's yours before someone else claims it. And now let's get back to Jake and Politics by Jake. All right, we're back. Now, let's talk some more. Let's talk about swap lines. In 2008, after Lehman collapsed, and there was this big crisis, I don't know if some of you remember, in something like September of 2008, there was this big crisis, and Larry Summers was there, Mitt Romney was there, or Mitt the Romney, as I like to call him, and Barack Obama was there. He had not been yet elected to the presidency. Lehman collapsed. Lehman Brothers collapsed. And the crisis was not just about American banks. So let me just take you back to 2008. Lehman, because this is big. This is a really big thing. Because Lehman Brothers was not just some small bank. It was a 158-year-old investment bank. It was one of the pillars of Wall Street. It survived the Civil War. It survived the Great Depression. It survived 2 world wars. And then, in September of 2008, it collapsed. Why? Because of mortgage-backed securities. Here's the simple version, okay? In the early 2000s, banks began issuing large numbers of home loans to borrowers who had weak credit. Those loans were bundled together and sold as securities, mortgage-backed securities, okay? Then those securities were sliced up and repackaged into even more complex products called collateralized debt obligations. The theory was diversification. The reality was leverage, massive leverage. And when housing prices stopped rising and then started falling, defaults rose. Those securities began losing value, and because major banks were leveraged, meaning they had borrowed heavily to buy these assets, losses multiplied fast. Lehman had enormous exposure. When confidence in those assets evaporated, lenders stopped lending to Lehman. Credit markets froze. And here's the key point. It wasn't just that Lehman lost money. It was that nobody trusted anybody else's balance sheet anymore. Interbank lending froze. The overnight funding markets froze. Repo markets seized. Money market funds broke the buck, and that means even supposedly safe cash funds dipped below $1 per share. That, my listeners and viewers, that is financial panic. So when Lehman was allowed to fail on September 15th, 2008, the shock wasn't symbolic, it was systemic. Markets around the world crashed. Banks in Europe that held dollar securities, held dollar liabilities. Suddenly, they couldn't get dollars. That's when the Federal Reserve stepped in with swap lines because the crisis was no longer about housing, it was about dollar liquidity. The entire global system runs on dollars. And when dollar funding disappears, the whole machine stops. That's why that matters in this conversation. Not because of mortgages, but because it revealed just how dependent the entire world was and still is on dollar plumbing. So after Lehman collapsed, the government faced a choice. We can let the system burn or we can intervene. And they decided to intervene. And TARP was created. And that's an acronym, and it stands for the Troubled Asset Relief Program. Hundreds of billions authorized. Federal Reserve expanded its balance sheet. Liquidity flooded the system. It was controversial. It was unpopular. But it stabilized the machine. And again, only the issuer of the reserve currency could do that at scale. And I'm going to go on more with this. Here's the part that people forget. Lehman didn't just fail financially. It shattered confidence. And confidence, that's the invisible fuel of the financial system. Banks don't just hold money. They lend to each other overnight. They assume the other bank will be solvent tomorrow. They assume the collateral is real. They assume the system works. That's belief. And when Lehman collapsed, that belief snapped. Suddenly, every institution looked at every other institution and thought, are you next? And that's when lending stops. That's when repo freezes. That's when money market funds wobble. That's when even safe assets start to look unsafe. It wasn't just numbers on a spreadsheet. I mean, this is just really important, guys. I know it's kind of eye glazing over time, but just stay with me on this. It wasn't just numbers on a spreadsheet, it was psychological contagion. And financial systems are uniquely vulnerable to that kind of contagion because they're built on trust. You don't inspect every dollar you receive. You don't audit every counterparty personally. You operate on shared confidence. And when that confidence breaks, the machine stops. Now think about that in reserve currency terms, okay? The dollar is dominant because the world believes the system will function tomorrow, because they believe the Treasury market will be liquid tomorrow, because they believe the Federal Reserve will act if necessary, because they believe United States institutions will hold. If that belief weakens, not collapses, but weakens, the consequences ripple, not dramatically, not instantly, but steadily. And here's the deeper psychological truth, okay? In 2008, the crisis was not housing, it was trust. In 2020, the crisis was not a virus, it was liquidity confidence. And if confidence in institutional stability ever falters, that becomes the real risk. Because money is not just paper, it is belief made tradable. So, in other words, when Lehman collapsed, the crisis was not just about American banks, it was about dollar funding. European banks had dollar liabilities, they needed dollars immediately. The Federal Reserve opened swap lines with foreign central banks, hundreds of billions, then trillions, injected calmly. And remember what President Bush, the younger, said. He said, if we don't give $750 billion to shore up Deutsche Bank, the whole system is going to collapse. That's what happened on Friday afternoon, that Friday afternoon in September. That was the report to the American nation, and it was like holding a gun to the head of everybody in the world. So, but the Fed came through. It injected hundreds of billions and then trillions calmly, without panic. And this is what a reserve issuer means. And at this point, let's take another break and we'll be back. And this is Politics by Jake. And now here's a word from one of our sponsors, Twain Consulting. Hi, this is Jake with Twain Consulting. Imagine, if you will, having the power to disappear from the prying eyes of creditors, identity thieves, nosy strangers, all while protecting what you've worked so hard to build. That's what virtual invisibility offers. It's not magic. It's smart legal and business strategy to shield your assets and privacy so you can live free, confident, and in control. Most people think that asset protection is only for the ultra-wealthy, but it's for anyone who wants peace of mind and financial security, including you. Don't wait until it's too late. Take control now. Call me at 213-465-0639 or go to facebook.com/Twain Consulting to learn how virtual invisibility can protect you and your family, because when you're invisible to risk, you're unstoppable. Now let's get back to Jake and Politics by Jake. Okay, and this is Politics by Jake, and we're back. So let's talk now about pandemic shock. In March 2020, markets freeze. Even U.S. Treasuries show illiquidity. The Fed responds. Massive Treasury purchases, repo facility expansion, swap line reactivation, trillions deployed in weeks. Stability restored. No crypto network can do that. And obviously, as you hear me talking about this, I think you hear in the back of your head, at some point, Jake is talking about this because he wants to address the issues with crypto. And yeah, we're going to do that. But I haven't really talked about crypto until now. So the thing that I want to point out to you, no crypto network can ever do that. Crypto is incredibly volatile, and you're seeing this. That's not going to work for a reserve currency. No decentralized ledger can inject $2 trillion overnight into the global banking system. Reserve currency requires elasticity. Bitcoin, it's a fixed supply. Elasticity is incompatible with fixed supply. It just is. Okay, so let's talk about the repo markets. Repo is the overnight collateral market. Now, let me explain repo, because this is one of those words that sounds technical, but it's actually simple. Repo stands for repurchase agreement. It's essentially a short-term loan, usually overnight, backed by collateral. Here's how it works in plain English. Say a bank needs cash for a day, okay? It owns U.S. Treasury bonds. So it sells those bonds to another institution with an agreement to buy them back the next day at a slightly higher price. That price difference, that's the interest. So repo is short-term borrowing secured by treasuries. And why does that matter? Because this is how the financial system finances itself. Every single day, trillions of dollars move through the repo markets overnight. Banks, hedge funds, institutions, they all depend on it. If repo freezes, liquidity freezes. If liquidity freezes, payrolls freeze. If payrolls freeze, the economy freezes. And here's the crucial point. The Federal Reserve stands behind that system. If repo rates spike, as they did in 2019 and again under stress in 2020, the Fed can inject cash directly into that market. That's called the repo window. It means the central bank can lend against treasuries to stabilize short-term funding. That's not ideological. That's structural. That is what keeps the plumbing from bursting. Now, here's something even more profound, okay? I've already explained to you that the dollar system operates 24 hours a day. When New York closes, London is active. When London closes, Asia is active. When Asia closes, New York opens again. So there's no pause. There's no overnight shutdown. Global trade, commodities, derivatives, shipping contracts, foreign exchange, called Forex, all of it settles continuously. Oil priced in dollars, copper priced in dollars, wheat contracts in dollars, debt instruments in dollars, and dollar clearing is global and it's constant. This is not just the U.S. system. This is planetary. This is a planetary settlement network. So when we talk about replacing the dollar as the reserve currency, we're not talking about replacing a symbol. We're talking about replacing a 24-hour, multi-trillion-dollar settlement machine that never stops. And that machine depends on deep Treasury markets, repo liquidity, swap lines, clearing banks, legal predictability, central bank backstops. You can't replace that with a slogan. You can't replace that with a blockchain that processes a fraction of that volume. You cannot replace that with a country that closes its capital account when volatility appears. Scale is not theoretical, okay? Scale is operational. 1 to 4 trillion daily in normal times. 1 to 4 trillion daily. If repo freezes, global system freezes. Only the Federal Reserve can backstop that market at unlimited scale. That is structural dominance. So let's talk a little bit about exorbitant privileges. Economists call this, or I should say economists, call this exorbitant privilege because the U.S. can borrow cheaply, run deficits, finance crises, absorb global savings, but that privilege, that requires discipline. To supply the world with dollars, you must run trade deficits. Reserve status, it's paradoxical. It requires maturity, not chaos. So let's talk a little bit about the war on the dollar. Because I know you hear these things. And this is a harder question. There's always been resentment towards dollar dominance. Because of Bretton Woods, everything was tied to the dollar. So there was absolute dollar dominance from 1944, well, earlier than that, but 1944 onward, which is when Bretton Woods occurred. France resented it in the 60s. De Gaulle wanted to come get his gold. He wanted his gold back. Russia resents it for sure. China wants autonomy. The BRICS explore alternatives. But resentment is not replacement. Replacement requires infrastructure. However, erosion does not require replacement. It requires diversification. So, in other words, if central banks slowly reduce dollar reserves from, say, 60%, then to 55%, then to 50%, that matters. That's not dramatic, but it's compounding. So, all right, let's talk about crypto. Bitcoin can't replace the dollar because it lacks elasticity. Stablecoins, though they are dollar proxies, they extend dollar reach. Now, let me slow down here because some of you may not live inside this stuff every day, and I get that. So when I say stablecoin, what do I mean? Well, stablecoin is a type of cryptocurrency that is designed not to fluctuate wildly in price like Bitcoin. Bitcoin, you know how volatile Bitcoin is. Bitcoin moves up and down. A stable coin is pegged, usually 1-to-1, to a real world currency, most commonly the United States dollar. This is why I've said that generally speaking, crypto, it's not backed by anything. It's pie in the sky. It's literally smoke and mirrors. But the popularity of the stable coin is that it's pegged to a real world currency. So if you hold 1 unit of a major stable coin, it's supposed to equal $1. So how does that work? In theory, the issuer holds reserves, typically U.S. Treasury bills or dollar-denominated assets, backing every coin issued. So a stable coin is really not anti-dollar. It's really a digital wrapper around the dollar. And the dollar, it's like the dollar wearing a crypto costume, and that matters. Because when people say stable coins threaten the dollar, what they're often describing is actually an extension of dollar reach, just outside traditional banking rails. And at this point, let's take another break, and we'll be back, and this is Politics by Jake. And now here's a word from one of our sponsors, Twain Consulting. Hi, this is Jake with Twain Consulting. Let's be blunt, shall we? America is litigious. It's unstable, and it's financially weaponized. If your name is on everything you own, you're a sitting duck. At Twain Consulting, we help you vanish legally, ethically, and permanently. From land trusts to layered LLCs, we teach you how to restructure your assets so the predators can't see them and can't touch them. This isn't a loophole. It's a strategy that the wealthy have used for decades. Isn't it time you got the same protection? Call Twain Consulting at 805-380-5699 or visit us online. Protect what's yours before someone else claims it. And now let's get back to Jake and Politics by Jake. Are you tired of the noise and the spin? Do you want the real story behind the headlines? I'm Jake, and this is Politics by Jake, where I tell you what they won't. And now, we're going even deeper, and I need your help to keep doing it. Join me on Patreon and support independent political analysis that doesn't pull punches. You'll get insider breakdowns, you'll get bonus clips, and first access to new content. So go to patreon.com/politics by Jake. That's patreon.com/politics by Jake. No filters, no fluff, just the truth. Let's do this together. Okay, and this is Politics by Jake, and we are back. And we had just kind of started talking about CBDCs. And we talked about how they can reduce reliance. Well, we began to mention it. How they can reduce reliance on U.S. rails. Now, CBDC. Again, let's define that for our audience, okay? CBDC stands for Central Bank Digital Currency. This is not Bitcoin. It is not decentralized. It is state-issued digital money. And just, think of it as a digital version of your country's currency, issued directly by the central bank. China is experimenting with one. The European Union is studying one of these. The United States has debated the idea, but has not implemented one. And what a CBDC would do is it would allow governments to move money instantly within their own financial system. Now, Here's the key difference, okay? A stablecoin, privately issued, but it's backed by reserve. A CBDC is a government-issued digital currency. Both operate digitally, but only one is sovereign money. And neither one, at present, replaces the structural capacity of the United States dollar as a reserve system. And at this point, I just want to step back by saying you're seeing the attempts continually, whether they are purposeful or whether they're incidental, to destroy the United States dollar and to destroy the reserve system of this. And this is what you're seeing, these machinations continually that you're seeing. This is what it's about. So if digital settlement increasingly if digital settlement increasingly bypasses U.S. banking infrastructure, leverage declines. Okay? Now, here's the contradiction. If political leadership... Now, and at this point, I want to translate that. I'm going to explain that. So let me translate that into plain English. Right now, most of the world's big transactions run through this American plumbing, through this structure that I've been talking about. If a country buys oil, if a corporation borrows money, if banks move billions across borders, at some point, that transaction likely rubs up against and touches the U.S. dollar system. It clears through United States connected banks. It settles in dollars. That gives the United States influence, not because we're loud, but because the transaction rubs up against and touches our rails. Now imagine, that over time, and this gets to the point here, countries begin settling trade another way. Maybe it's a digital currency issued by their central bank. Maybe it's a bilateral digital settlement system. Maybe it's a crypto-based clearing network that doesn't touch U.S. banks at all. If that happens more and more, then fewer transactions flow through American financial pipes. And here's why that matters. When transactions don't touch your system, you don't control the switch. You can't freeze assets. You can't enforce sanctions as easily. You can't monitor capital flows as clearly. And your ability to influence behavior commensurately declines. That's what leverage declines means. It means your grip weakens. Not overnight, not dramatically, but transaction by transaction, bit by bit. Think of it like this. If everybody in town shops at your store, you have influence. If, over time, they start using a different marketplace that doesn't go through you, you're still open, you're still important, but you're not central anymore. See, that's leverage. The dollar's power is not just that people use it, it's that so much of the world's trade flows through systems the United States oversees, and it overlooks overseas, not overseas like across the Atlantic or Pacific Ocean, although that's true. If digital settlement builds parallel highways to that, then fewer cars are going to drive on ours. And there's people out there who want that to happen. And that's war on the Federal Reserve System, and that's why we're talking about it. Fewer, again, using the parallel highway concept, fewer cars drive on ours. Fewer cars means less control over traffic. That's the point. So leverage in this context, it's not about bullying, okay? It's about structural influence. If your currency is the settlement layer of global trade, you have tools. If settlement shifts elsewhere, those tools become duller. That doesn't mean the dollar collapses. It means influence becomes narrower. And influence is power. And at this point, let's take another break. And this is Politics by Jake, and we will be back with more of this. And now here's a word from one of our sponsors, Twain Consulting. Hi, Hi, this is Jake with Twain Consulting. Imagine, if you will, having the power to disappear from the prying eyes of creditors, identity thieves, nosy strangers, all while protecting what you've worked so hard to build. That's what virtual invisibility offers. It's not magic. It's smart legal and business strategy to shield your assets and privacy so you can live free, confident, and in control. Most people think that asset protection is only for the ultra wealthy, but it's for anyone who wants peace of mind and financial security, including you. Don't wait until it's too late. Take control now. Call me at 213-465-0639 or go to facebook.com/Twain Consulting to learn how virtual invisibility can protect you and your family, because when you're invisible to risk, you're unstoppable. Now let's get back to Jake and Politics by Jake. The world is unraveling fast. Governments are weakening, markets are crashing, chaos is looming. You need more than hope. You need a plan. Collapse Protocol gives you the tools to protect your assets, secure your future, and survive the storm. Don't wait for the collapse to hit. Prepare now. Visit Twain Consulting at facebook.com/Twain Consulting or call 213-465-0639. Collapse Protocol, your shield when everything else fails. All right, and this is Politics by Jake, and we are back again. So let me give you a real-world example on this, okay? Why settlement matters. And let's talk about sanctions. When the United States sanctions a country, say Russia or Iran, how does that actually work? It works because most global transactions are settled in dollars. And remember how I told you that countries don't necessarily like the fact that this is the case, because it gives an exorbitant preeminence to the United States, so they can basically boss people around. Or so these countries think, who want to do things their own way. And those dollars pass through banks that clear in the United States or through U.S. connected financial institutions. And if you touch the dollar system, you're within reach of U.S. regulators. And that means the U.S. can say, if you do business with that sanctioned entity, you lose access to dollar clearing. And that's not symbolic. If a foreign bank loses access to dollar clearing, it is effectively cut off from the global financial system. And that's economic oxygen, baby. Now imagine a future where more and more trade settles outside the system. Are you beginning to see this? Are you beginning to see the concept? Why there are attacks on the dollar and attacks on the Federal Reserve System as the lender of last resort? Oil contracts settled in a digital yuan. Bilateral trade cleared through a regional digital platform. Crypto rails that don't pass through U.S. banks at all. If those transactions never touch United States infrastructure, then U.S. sanctions become harder to enforce. Not impossible, but weaker, because enforcement depends on jurisdiction, and jurisdiction depends on the transaction touching your system. If the transaction never enters your system, your reach shrinks. That's what declining leverage looks like. It's not a dramatic collapse, it's a reduction in the number of switches you can flip. And in geopolitics, the ability to flip switches, that really matters. See, sanctions work because the dollar system is central. If a settlement bypasses it, enforcement weakens. Now, here's the simple, it's a subtle thing, but it's an important thing. So, how does this touch the working man? You might be sitting there thinking, okay, fine, sanctions, global leverage, That's Washington stuff. What does that have to do with my mortgage? Well, I'm glad you asked. Here's what it has to do with you. The dollar's reserve status creates constant global demand for U.S. Treasury bonds. Foreign governments, central banks, and institutions, they all buy treasuries because they need dollar reserves. That demand keeps U.S. borrowing costs lower than they would otherwise be. Now, think about that, okay? If global demand for treasuries softens, even gradually, the U.S. government will offer higher interest rates in order to attract buyers. Higher treasury yields, the rippled outward. Mortgage rates rise, auto loan rates rise, credit card rates rise, business borrowing costs rise. And that's not theory. That's just that's just what's going to happen. Treasury yields are the benchmark right now for the entire credit system. If the cost of government borrowing goes up, the cost of your borrowing goes up. That's what the prime rate is all about. And if borrowing costs go up across the economy, growth slows, hiring slows, expansion slows. That's how something that starts as a reserve currency leverage eventually shows up in your monthly payment. You don't see it as geopolitics. You see it as, why is my mortgage rate 8% instead of 5%? See? That's the transmission mechanism. So when we talk about digital settlement bypassing United States infrastructure, when we talk about declining leverage, we're not talking about some abstract policy, foreign policy chessboard, see? We're talking about the long-term cost of capital in your life. That's the bridge. It's just mechanics flowing from global structure to household reality. So, okay, I kind of diverged. We were talking about CBDCs, and we were talking about neither one at present replaces the structural capacity of the U.S. dollar as the reserve system. But it's trying to do that because if digital settlement increasingly bypasses U.S. banking infrastructure, and that's why I did that little digression there to explain that to you, leverage declines. Now, here is the contradiction. If political leadership celebrates crypto disruption while presiding over the reserve system, are we strengthening dollar infrastructure or are we fragmenting it? See, you cannot disrupt settlement rails and preserve monopoly leverage without tension. Markets just notice ambiguity, believe me. They're very sensitive to it. Ambiguity increases risk premium. Risk premium increases borrowing cost. Borrowing cost compounds debt. Debt compounds vulnerability. This is mechanical. This is not emotional, okay? So, all right, we've been talking about this, and I've kind of been making a case about this. What would erosion look like on the Federal Reserve System? It wouldn't look like collapse. It would not drift. Higher treasury yields, reduced foreign participation. This is what it would look like. Higher treasury yields, reduced foreign participation, more bilateral trade outside dollar channels, greater sensitivity to political instability, reserve erosion is quiet. It's quiet. Trust decays slowly, and rebuilding trust, it takes decades. So, okay. So, where does this all leave us? It leaves us here. The dollar is not dominant because of sentiment. It is not dominant because of patriotism. It is not dominant because of military power. It's dominant because it works. Because when the world needs liquidity, it's there. When markets freeze, it moves. When panic spreads, it stabilizes. That is not ideology. That is infrastructure. And infrastructure is invisible until it breaks. Most Americans, they never think about swap lines. They never think about repo markets. They never, ever think about overnight Treasury settlement. They never think about foreign central banks holding our debt. They just assume the system works. And for 80 years, it has. But here's the sober reality, okay? Reserve currency status is not permanent. It is maintained. It is earned. And it is earned daily through stability, through predictability, through institutional gravity, through boring competence. It's not exciting, it's boring. And that may be the least glamorous phrase you'll hear all week. Boring competence. But that's what underwrites the dollar. Not bombast, not spectacle, not volatility mistaken for strength, confidence. And confidence is fragile. Not because collapse is imminent, but because erosion is incremental. Look, if the world senses unpredictability, if fiscal policy appears reckless, if monetary authority appears politicized, if settlement infrastructure becomes ambiguous, then slowly, not dramatically, but slowly, the world begins to adjust. Again, not overnight, but quietly. Diversifying reserves, altering settlement patterns, demanding higher yields, pricing in risk. You won't see fireworks. You'll see basis points. You won't see headlines. What you'll see is marginal shifts. But marginal shifts compounded over years, that changes history. And so the question is not, is the dollar collapsing now? Is it collapsing tomorrow? No, it is not. The question is this: are we strengthening the institutional foundations that make it dominant, or are we taking that dominance for granted? Or are people attacking that dominance for their own selfish needs and desires? Because once trust weakens, rebuilding it takes generations. There is no other currency right now that can clear $5 trillion in crisis liquidity. There is no other system that can absorb global savings at this scale. There is no other machine that runs 24 hours a day and keeps the gears of global commerce turning. Remember that when you hear people talk about replacing the dollar. But machines require maintenance. Maintenance requires seriousness. And we remember that. If we remember that, then the dollar remains dominant. It will remain dominant. But if we forget it, the world will eventually remind us. And this isn't fear. This isn't alarmism. This is structural reality. And if you understand the structure, you understand the stakes. And this is Politics by Jake. And now here's a word from one of our sponsors, Twain Consulting. Hi, this is Jake with Twain Consulting. If you think owning things in your own name keeps you in control, think again. In today's world, lawsuits, taxes, and predators are everywhere. That's why the smart money hides in plain sight. We help you to build legal firewalls, LLCs, land trusts, private contracts that protect your assets while keeping you invisible. Call Twain Consulting today at 310-997-2204. Find us on Facebook at Twain Consulting. That's facebook.com/Twain Consulting. Protect what you've built before someone else takes it. And now let's get back to Jake and Politics by Jake.